Welcome to the live stream. It is Monday after the market has closed. It was April 21st. I hope you all had a nice weekend and we're ready to see the market sell off. It was kind of a rough day in the stock market. NASDAQ was down 2.55%. It could have been worse. It did recover some of its losses in the middle of the day. Kind of posted a little bit of intraday rally, coming back up a little over 1%. It could have been worse. It is a little bit of a silver lining. Kind of, read too much into that. At least it did rally towards the take place for us. So the Nasdaq is down close to 18% year to date. We did have a very loose correction, 24 from the top to the recent bottom, and it looks like if we follow this trend, we're gonna see this come down further. You could see it go down. I think I saw it. Brandon, good to see you. And looks like my mic might. Let me make sure I close out some browsers here. Make sure I'm not creating my own conflict. No, I think that should be it. Let me know how the mic is. Is the mic better? All right, good. Looks like I had a browser with something going on it. All right, thanks for letting me know. Um, yeah, well, I think the market is, if you follow this trend, if you were to draw a line across all these data points, we're on a downward trend. Now, it's not going to go down forever, but it's looking like it's going to come down. This volatility is scary here. We can go back there if some, you know, some, I'm going to call them provocative, high impact things happen. One of them out there is if the current president fires the chairman of the Federal Reserve, um, it could really push the markets down. Like, I think if that happened, we're going down another 20%. It's almost automatic. We would have a couple of real horrible days because that means that the Fed would have lost credibility, at a lot of levels, and it could be kind of a more of a permanent kind of issue where, well, who cares if they lowered interest rates in the short run? That person can be replaced next week kind of attitude. Instead, I think the chairman serves 14 years or 16 years once they're assigned, unless they have like there's reasons to fire the person if they're not doing their job. But we might not agree with the current chairman at all times, but I think he's doing a very good job overall. And he was assigned by Donald Trump. So it's like he assigned him. We kind of have a certain precedent when it comes to the chairman. So hopefully that doesn't happen because I'm sensing that's the new big story to worry about as it comes to stock prices is a chairman going to lose his job? If that happens, you know, build up a little cash because you're going to need it. I've built up some cash and will continue to build up a little more cash over time. I did buy some stocks today and, took advantage of some low prices. So that's the one story that worries me. There's two stories that worry me. One of them is kind of known, which is tariffs. Now, tariffs, the productive, aspect to tariffs is, I think the U.S. put tariffs out there, and the tariffs made some very bad things happen in the bond market. It rose interest rates, or it caused interest rates to really rise fast. And I'm glad somebody slammed on the brakes because we went up like a full 50 basis points, which is like a half of a full percent of interest in a matter of days. That was super fast. And if we woke up to like 10% mortgages, man, that would just be so painful for so many people. And the economy would really contract because people would A, be filled with more fear, but two, probably not finance as many things because not too long ago you can get a car loan for 4.9% or so. You're not going to pay 12.99%. You'd be like, oh my God, I'm wasting a lot of money unless you really, really need a car. And things like that, it would just be really, really bad. So when they announced those tariffs, it started to break some things in the economy that are really important. And it started to somewhat, it kind of drive the bus off a cliff and they stopped. Okay, great. The stock market most definitely um, is showing signs that it does not like the tariffs. I don't think I'm overanalyzing or overstating it. This 21% down on the NASDAQ. This is all, I would say 80, 90%. It's tariffs. Tariffs are what is driving down the stock market for a couple of reasons. Tariffs will slow down the economy. Businesses are already pausing, showing reluctance that, hey, we're not sure what's going to happen. So we don't want to overcommit capital in 2025. Earnings are here. And I think you're going to hear the caution in earnings. And that might be good, right? Overall, I believe in the American economy. I'm here in America, so I know a lot of you are outside the US, but let me kind of just state a few things. So in my whole life, I've seen this economy do all kinds of interesting things. At times, it just seemed really scary, like the dot-com bubble. I believed in dot-com companies. I believed in the internet during this time. I invested during this time. I ended up losing my entire investment in one startup, but I also made a lot of money over time by investing overall. And when the market sold off, I continued to invest. Then we had another time, which was in the 2008, economic meltdown. That was the Great Recession. I was smarter, wiser. I made more money. And I put a lot of money in the stock market and I put a lot of money into real estate. And that ended up being a really good idea. And I made money all the way from probably from 2010 to 2020. Those were great years for me from a return on investment, appreciation. And then we've got the last 5 years have been incredibly volatile. But again, I've probably made, like, in the 10 years from 2010 to 2020, I've probably made the same amount of dollars, like the same amount of money in the last 5 years than I did in the 10. And that's the way it's supposed to work. You're supposed to compound, and over time, you just make more money, per month, per year than before. Now, where I'm trying to get to is we got tariffs to worry about. What if the chairman gets fired? Well, that's going to be ugly. But the markets always bounce back. I mean, we got a full-blown pandemic. This pandemic that we lived through, it killed, and I don't want to be insensitive. I just want to put it out there from a reference point. It killed over 1 million people in the United States. And, I think it's a pretty significant event. Like, wow, we got through that and the market just kept rolling. We had a pretty good correction in 2022, got back on our feet, and for 2 years had just great appreciation. So now we're embarking on one more correction. And this correction has some aspects to it that are negative catalysts to the economy, negative catalysts to the stock market. But it's the American economy. We're going to get through it. And I'm trying to figure out which companies are the best ones to own going forward. And I have to look at how tariffs are going to affect those companies. A lot of my companies do not have a whole lot of tariff influence, or there's no negative aspect to those companies due to tariffs. I'm thinking about like Meta and Google. and Uber and so forth, there's like no tariff impact. Uber, there could be one for Uber, I guess, because all the imported cars, but they don't directly pay for those cars. The drivers pay for those cars. So the drivers might be squeezed because they're like, hey, I'm driving for Uber. I had to get a new car to drive for Uber and I had to pay more. But you think about Meta, maybe they have to pay a little more for the technology they're buying for their data centers, but not directly, not like a General Motors or, um, companies are importing a lot of stuff. So, or Caterpillar, right? Caterpillar is going to be hit with tariffs when they try to sell stuff in China. When they try to sell stuff in Europe, they're going to be hit with those tariffs because we initiated a tariff war. So those kinds of companies I do see an impact on, but a lot of the stocks that I own, very little impact, very little impact. So we'll see how it plays out. All right, so we've got a lot of people on the stream, which is usually the case on really down days. And what's important to keep an eye on is, speaking for myself, I'm going to be investing for the next 40 years. So this is a tough day. It's been a tough year. But at the same time, the opportunity is even better now than it was 4 months ago. 4 months ago, my biggest complaint was, man, stocks are really overpriced and I'm afraid we're going to get corrected and some of these stocks are really going to get beat up. Now I'm seeing more and more stocks that are discounted. So my long-term mindset, keeps me from buying into too much of this negativity and kind of gloom and doom kind of scenarios. Nope. I'm going to be fine. My family's going to be fine. I do diversify. Diversification is important. Even Warren Buffett diversifies. And my diversification is, part is really trying to be a good investor, but part of it is, I want to protect my family for the next 5 years, and my diversification into very low risk assets just to cover the next 5 years is a method of doing that. So that helps on times like this when it's like, man, the wheels are falling off on certain stock sectors. And is it really horrible news? Well, it kind of is if you needed to, have, let's say, Tesla, if you're living off the Tesla stock and you need to sell shares to pay your mortgage or pay for some kid to go to college or pay something, right? Something substantial, then it really, really hurts. But if you don't have to sell your shares, it's just a situation where stocks are correcting. We have seen this over and over again. It doesn't happen every year. It happens every couple of years. It's happened really 3 times in the last 5 years. One of them was a flash crash, which was COVID related. The other one was 2022, which I don't think anybody complained because 2021 was so darn good. The end of 2020 was so good. It seemed like the market was too expensive and it corrected. And we were getting really crazy on those SPACs. We had some stocks that were just super expensive and the market corrected them. And you don't hear about SPACs all that often anymore. But now, we're seeing, hey, we're going to correct. It's these tariffs. I think the U.S. government's aware that, hey, if we really want to tank the stock market and the economy, let's stay on this tariff path and, take it all down, I guess, is one path. But I think that would just be super ugly. I know it would really hurt a lot of people. So I hope they don't take that path. I hope they just figure things out and, do what's right for the U.S. So, so the market's corrected. Let's keep our chin up and keep analyzing stocks and figuring out how can I get wealthier over the next 5 years. It's not overly, kind of consume the negative press around this stuff. So that's where the stock market's at. The one thing that, crypto, this is one of the, when I started investing in crypto 2018, one of the promises was it's not going to be tethered to a government. Governments aren't going to be able to influence Bitcoin. They're not going to issue out a bunch of, new currencies and stuff, which would then devalue Bitcoin. And it's standing up really tall right now. Bitcoin is. It's going up in value while the stock market's going down. So I'm really impressed with Bitcoin right now. And if it keeps going up while the rest of the market's just getting destroyed, I think Bitcoin's going to find many, many more new organic net new investors in Bitcoin that are looking over there going, hey, stocks are getting destroyed. Very few other options other than stocks and that are really liquid. Maybe bonds or money market accounts might be super liquid, but those don't appreciate very much. Bitcoin has appreciated really well. And you look at the 5-year, 1,000%. Over the 1 year, 34%. From 2018. When I started investing, if I would have no, that's not the type of investor I am. I started investing small amounts and continued to dollar cost average into Bitcoin. I bought in this period here, and it's just really taken off. So Bitcoin's really standing up tall, and it's a alternative asset class. It's how you diversify away from stocks. That's why I invested in Bitcoin. I don't like gold. I don't understand gold. Some people do. Good for them. My digital gold is Bitcoin. So I'm glad I'm an owner of Bitcoin. I'm glad I invested a little bit of money, which is now a pretty good pile of value. And I've been selling some of my Bitcoin just to create some cash, but I have been selling stocks as well. I've been selling bonds, just creating a good pile of cash. I have a good pile of cash going, and I don't want to get caught in a market that sells off even further without having cash. I want to have that cash so I can really take advantage of low stock prices if the market really crumbles more. So Bitcoin's standing up tall. Go Bitcoin. So stocks, crypto. Let's take a look at the heat map. It looks pretty red. It's like Christmas time is back. It's pretty bad out there, and Tesla's just getting destroyed. Man, we'll take a look at Tesla in a little bit. Amazon's just consistently getting destroyed. My wife and I were having breakfast, and she asked me about Amazon. She's like, "What's going on with Amazon?" And we got into a conversation around that. But I think the level of correction and the stock market going down is catching the attention of the average person, like my wife. So I think the whole general population now is understanding, hey, the stock market's really going down, and we're kind of in a little bit of peril. The economy's bad, stock market's bad. What else is going to get bad? So Amazon's down, Nvidia's down big. Nvidia's down also, although Nvidia was down 5%, so it kind of came back a bit. Apple is down. So the stocks that were kind of the big winners over the last 2 years have seen pretty good losses. So it's important to be a stock picker. So interesting. And thanks for the comments, guys. I'm going to catch up on comments in a bit. Thank you so much for joining. Now, when it comes to sectors, the top sector was materials today. Let me refresh this, make sure I've got the latest and greatest. Right, so materials didn't go down as bad as everybody else. It's it only went down 0.83%. Staples, healthcare, financials. Worst sector of the day was technology. No big surprise, and it's down the worst. Consumer discretionary was down, and industrials are down quite a bit. So it is it's a tough year. It is a tough year for stocks. So the good news is PE ratios have been getting a lot better. So if we study PE ratios, I would say that like the PE ratios, let me show some of these charts. These are not the best charts, but it's the best that I've got access to just to make a point. So this is PE ratios on the S&P. And at the end of 2020, the PE ratios had really just gone crazy. And stock prices had really gone up high. And P ratios began to settle down. And when we got into 2022 and we had a correction, they really came down. Okay. And then the stocks began to rally and PE ratios began to really rise. We're seeing a drop in PE ratios. Okay. We're beginning to see PE ratios are dropping. And it's a combination of two things, two trends that kind of act in opposite directions. So earnings are coming down. Companies are not going to make as much money in 2025, probably in 2026. So the earnings are dropping. Okay. And stock prices are also dropping. So that is going to somewhat keep the PE ratios a little more consistent because they're both dropping in the same direction. So that's what I'm seeing out there. I think if the stocks continue to drop in value and earnings can stabilize or even grow, it'll be very favorable for PE ratios. We'll go back to nice PE ratios like we did toward the end of 2022, where you had PE ratios under 20, where right now we're at 28. So we'll see how that plays out. This data is hard to track because it's all rear view mirror data. You're looking at it and it's a quarter old or so. And obviously, as we get refresh data, it'll be interesting to see how the PE ratios look. When I look at a different way of looking at it, here we're at the end of 2024, and it's measuring at 28. And if I were to go to stock analysis and look at the PE ratio on the S&P, and this is an ETF, gets me in the ballpark. P ratios have dropped to 22.7. That's how severe the drop has been in the first quarter of 2025. That's a real good move in the right direction. That way I sense that, hey, stocks are not as overpriced as they were before. We had a drop from almost 30 down to 22.7. Hey, that's looking like, we're definitely getting corrected. If that drops below 20, we're now getting back to the territory in 2022 when we saw the market pivot and start to appreciate, and it just really went on a great appreciation run for 2 years. So history doesn't tend to repeat itself perfectly, but it tends to rhyme. It tends to kind of, resemble, what happened in the past is going to resemble things that happen in the future if you look at certain criteria. And I've been looking at PE ratios, seeing, okay, what's going on with them? In general, does the market look discounted? Does it look enough discounted? And I think at this point, we could see the market sell off more, especially if you get some of these concerning stories. The president firing the chairman of the Federal Reserve, or tariffs, some new stories come out where, maybe a government is really getting hostile towards another government as it relates to tariffs. That kind of stuff could drive the market down. And of course, earnings are really have started and are really going to get cranked up starting tomorrow, which is something I wanted to talk about. So Bushy 1147, you want to look at BITO ETF? Yeah, we can look at that. So let me get back to earnings. Let's check out BITO. So this is the Bitcoin ETF, kind of jumping off point on Bitcoin. And there's obviously like different ways to invest in Bitcoin. I bought Bitcoin and I started investing in Bitcoin when there weren't ETFs. So I kind of got accustomed to buying Bitcoin and I'm good to go. It is expensive to buy Bitcoin individually. It's a little difficult. It's a little risky too. You got to manage your own wallet and so forth. It's very different than a stock, right? And these ETFs do make it easier. Just be careful with how much management fee they're charging. I don't know what these guys charge, but this one's done. I think it's doing okay. Oh, it's down 16%. It's down 32%. Well, that's weird. Bitcoin itself is doing well. So the expense ratio is 0.95%. That is a pretty pricey amount. But compare it, right? Like if you trade on Coinbase, it's pretty expensive. If you trade on your brokerage, check out the expenses that you need to pay every time you transact. It's not free. It costs money. Now this one is kind of weird because this is Bitto. Let me see if I can. So here's Bitcoin on the blue line, and here's Bitto on the gold line, right? Well, why aren't they kind of matching? That doesn't make sense to me. So over the 1 year, Bitcoin is up 34%. Am I reading this correctly? So ProShares Bitcoin ETF. Is this the inverse? So long BTC, short US currency. So that's strange. This is like the inverse result of what Bitcoin's done. Moves exactly with Bitcoin. So not sure why this is not performing well. So so these are buying contracts. They're not buying Bitcoin. Okay. Yeah, I mean, this doesn't make any sense to me why it's negative. If it's investing in Bitcoin, long BTC, short US currency. Yeah, so that should be Bitcoin. I'm not sure why it's not doing better. So, I'm not familiar with that ETF. I am familiar with Bitcoin. I really have never bought an ETF around Bitcoin. I've just bought the Bitcoin itself and Ethereum and a couple other coins that really didn't amount to much. So most of my investment is in Bitcoin, like 70% Bitcoin, 30% in Ethereum. Yeah. So interesting that you brought that one up. I would really question, what's the benefit of this ETF? If it's not going to give me the upside appreciation when Bitcoin's doing well, then why am I invested in it? Under what conditions would this be doing better? I don't get it. Over the last 5 years, Bitcoin's done really well. So I am not understanding that ETF. Bitcoin's up 1,054%. This one's down 51%. I'm scratching my head thinking, what happened? Is there a big do they pay a dividend? So they have a dividend yield. Huh. In the form of what? So yeah, this is an ETF that I'd have to study closely because they're buying contracts, not the coins themselves. It's probably a synthetic kind of investment, and it's providing a yield in the form of dividends. So that's why the underlying assets or the price of the ETF is going down, but the yield's been off the charts. So this brings up a lot of questions like, so are you paying ordinary income on the dividend yield? Like my holding of Bitcoin, right? It's all long-term holdings. So I'd pay long-term capital gains, which is more desirable tax rate. This one here would be ordinary income if it's a dividend yield. So interesting, man. You got me. Uh, this one doesn't make sense to me because there's so many things that are not like Bitcoin on this ETF. So interesting you brought it up. I'm going to study those a little more and try to be a little more informed. I've never gotten into ETFs around Bitcoin, so I appreciate you bringing it up. I'm going to ask some of the Bitcoin friends that I have online that really know Bitcoin and ask them what their opinion is. Yeah, thank you for asking, Bushy. Sorry that I didn't have a clear answer because it's very different. Isn't it interesting how different these two investments have acted? But on the surface, you would think, oh, okay, this is based on Bitcoin. In essence, buying an ETF where they're buying Bitcoin, storing it somewhere, and I own part of that, part of the overall holdings. Nope, not that at all. Because when you buy an ETF, like if you buy the S&P ETF, the one that I showed a minute ago, you're somewhat buying a little slice of this particular set of stocks, and you're over diversifying, right, across all these. You're paying a small management fee. I think this one has a small management fee, 0.09, and they are spreading your investment across the S&P 500. So as the S&P goes up, so does this. And that's what I expected that ETF to do, but it surprised me. It's like, whoa, it's buying contracts and so forth. So thanks for asking. All right, let me catch up on comments and then I'm going to hit the earnings. So Shadow Guy, good to see you. Brandon, great to see you. Yeah, tariffs are getting old. Hopefully they go away at some point. Yeah, thanks for the comments on the mic. Rotel and Cheese, good to see you. Yaz, good to see you. Jay Zav, good to see you. Bear Light, good to see you. Anthony Ferguson, Sergio, good to see you guys. The dollar dropped more too, for anyone keeping track. Yeah, the dollar has been losing value. And if you see the dollar lose value against other currencies, that's going to create inflation in the US because it's another way of the US market having to pay more for products. Is if we have to pay more dollars because the exchange ratio changed, that'll create inflation. So that's another inflationary issue in seeing the dollar lose value. So again, I think the big changes that tariffs are making are kind of breaking a few things, and some things were unexpected, but hopefully they pump the brakes on all that. So Brandon, what are my thoughts on Meta, Google, antitrust lawsuits? Yeah, let's talk about that. So Meta and Google, antitrust. Cool. I'll talk about that. That'll be next. Michael Anthony, good to see you. And then if you'd like me to take a look at Pfizer, $5 super chat, I'd be glad to take a look at it. Josh, good to see you. Thanks for coming in. A lot of good comments. Thanks, everyone. Trying to say hello to everybody and speed read the comments so I can get back to talking about specifics. And do I own any boat? Michael Anthony, not Michael Anthony, Anthony Ferguson. Michael Anthony's the bassist for Van Halen. I'm sure there's another Michael Anthony too. I don't own boat. Okay, so let's talk about Meta and Google, and we'll talk about them. We'll talk about Meta first, and Meta is in the process of uh, working, I think, with the FTC and going through court and seeing if they're going to be forced to potentially break up Meta. And Meta is a collection of social apps: Facebook, Instagram, WhatsApp. Now they have Meta AI, and they have Threads. And there's, I think, some government leadership is thinking, hey, we think you have too much power when it comes to your combination of having Facebook and Instagram and WhatsApp, and you're kind of controlling those markets without letting competitors come in and compete in those markets. And in a way, that's definitely the case, because they've done a really good job. The one, I think, example that Meta can point to and say, we can try everything to keep innovators out and, really creative companies from coming in and taking market share. But look at TikTok. TikTok has come in and created just a big splash. Like they've gotten so many users, and it's because they really advanced the experience on social apps. And now TikTok is making Google in YouTube. In the case of YouTube, YouTube didn't have shorts. Now they do. Now YouTube Shorts is big. And Instagram wasn't as video driven as it is now. And Meta is looking to launch a business that's going to compete against TikTok. So I think Meta can point to that and say, look, there's plenty of competition. TikTok is a perfect example where you can try to break up Meta. And what you're going to do is you're going to break up a company, and pretty soon, maybe you're going to get an outcome that nobody wanted, which is maybe in the US specifically, another foreign successful company comes in and takes market share. And then you're like, wow, we started with one Meta and we had all this US market share. Now we have a broken up Meta, and we have TikTok, which is predominantly or Chinese owned. And then you have, who knows, some other, maybe another Chinese entity has a successful social app. People love it and they use it a lot, and they don't care that it's a Chinese owned company. Then the US is like, wow, we created a bigger problem than we were trying to solve, which is now we have, less control of social apps. Now, I don't know if they're going to force Meta to divest Instagram. I think it'd be a mistake. In the case of Microsoft, it's kind of going back through the history books of companies that have done really well. And Microsoft was deemed a monopoly, and it was deemed to be doing a lot of things that were very anti-competitive activities. And they were doing like the browser business. Netscape came out, and then Microsoft used its powers illegally and put Netscape out of business. That's, textbook. That's what you're not supposed to do. Even having done that, kind of Microsoft got away with it. They were not really broken up. They were governed more closely, but Microsoft's still the Microsoft that existed when that happened. So the whole antitrust process with Microsoft didn't fundamentally change Microsoft. Moving on to Meta, it's too early to tell, but I'm got my fingers crossed because I'm a big Meta stockholder that in the end, Meta agrees that they're going to comply to certain requests that the government makes, and then they move forward. and they'll be continued. The oversight will be there so that they have to honor the commitments they're going to make and so forth. I don't think they're going to be broken up. If they are, it'd be disappointing more from being like a fan of like companies that are doing well. I think when the government kind of gets in their way too much, kind of gets in the way of these companies that are creating a lot of jobs, that are doing so much for the economy, right? That's my opinion on it. Now, would it be profitable from a stock perspective? Potentially. I mean, I'm sure if you spun off Instagram, that would be worth a lot. And then Facebook alone would be worth a lot. So I think from an investment perspective, it would probably be, it'd probably be okay. But I'd rather see Meta stay together. I think we're in an era where these companies really do need to be big to really be successful against the other big companies. Because here's a perfect example where antitrust completely fails everybody, and it's away from tech. Kroger, right? So let's study Kroger really quick, and then I'm going to come back to Google. So I'm a Kroger stockholder, and I've been a Kroger stockholder for a while. Now, the grocery business is not high tech. It's not Google. It's not Meta. And the previous administration, and I got nothing against them. I'm sure there are people that were trying their best. But the Federal Trade Commission told Kroger, you cannot acquire Albertsons. Now, Kroger is a really good company. Like, they're really well operated. And what Kroger explained to the stockholder and to the FTC was the grocery business has really changed. If you look at Walmart 30 years ago, they really didn't sell groceries. They didn't sell fresh produce. They didn't sell that stuff. Now they do. So Walmart has a huge advantage, which is you go to Walmart to buy your essentials for home, maybe all the paper goods you need. Oh, and you stop by the fresh foods aisle and you pick up some food, some milk, and all that stuff you need. Well, they just took away a share that Kroger and Albertsons once had. And let's move on to Amazon, the number one e-commerce company on the planet, is into grocery now. They have Whole Foods, and then they have Amazon Fresh, which is a line of grocery stores. And again, Kroger explained the industry is now has these two massive, and really in moving on to Target, because they put Target in the argument. Target also, 20, 30 years ago, you walked into a Target, there was no food. It was just basically merchandise. But more recently, they realized food creates foot traffic. If somebody comes in for milk at Target, maybe they end up buying a few other incidentals, like, oh, I need laundry detergent. Oh, and my kid needs a new pair of socks. So they buy a few things, put it in their basket, and they check out. So Kroger's now battling Amazon, which is $1 trillion market cap company, e-commerce giant that's in the grocery business, competing against them. And you have Walmart, the merchandise kings, and they're humongous, massive market cap, so powerful. And you have Target, massive company, and so forth. And the FTC, again, it's just a dumb move. They said, no, we're afraid that Kroger, you're going to make it hard for grocery companies to compete. And it's like, you guys are missing the whole boat. Kroger's not doing that. It's Walmart, Target, and Amazon. They're the ones that are creating massive competition against these small grocery stores. Kroger's in strategically trying to survive, trying to adapt to this economy we have, which is really integrated. Like Amazon's integrated e-commerce with food and food delivery and all that stuff. Walmart, merchandise and food. Target, merchandise and food. So that was where I just thought the FTC, they're not really wise. They're kind of really dumb. And if you look at um, the Albertson stock, it is not doing well. Albertsons needed the merger with um, they needed the merger with Kroger more than Kroger needed Albertsons. I think they would have been better together and they would have formed a better combined entity to compete against Amazon, Target, um, and Walmart. Instead, the FTC was like, nope, we think you're going to create an unfair environment. And I just thought, you guys are nuts. What are you talking about fair? You're going to put up this company against Amazon. That is like completely backwards. This is David in the whole story, David and Goliath, David being the smaller, kind of participant in the battle. This is the small David participant, and Amazon is Goliath. It's this big entity, but the FTC didn't see it that way. So back to Meta and Google. Who knows what the FTC does? There is a new administration in office. Fingers crossed that they're far wiser than the one that just left. And the one that just left was really kind of on their way out. It was they were without it being overly played out. They were pretty much they got F grades or 1 stars out of 5 on their way out. I think they would have argued that we're protecting the consumer, and it's like, nope, you didn't protect anybody. So there's a new administration. Hopefully, this administration is not, um, losing sight of the big picture. That we're in a fully digital economy that's fully connected, and Meta and Google should be controlled. They shouldn't be like doing things that are against the values of the US or whatever country they operate in. They should really follow those rules. At the same time, Meta was created by innovations that happened in the last 25 years. And that's great. And they created these social networks, and they created a company that's worth 1.23 trillion. Let them keep being successful, creating jobs, creating value. Same thing with Google. Google was founded 30 years ago. Yeah, about 30 years ago. And it was created by 2 young graduates of a university. And they created this $1.85 trillion market cap company. They do things so well that, yes, they kind of created a monopoly because they do it so well. Now, it's kind of a paradox, or it's kind of broken thinking in my book, where governments are like, well, you're too good. We need to kind of limit you to let your competitors catch up. And your competitors may not be as good as you, but we're gonna break you up. It'd be like going to an athlete and saying, it's basketball season, right? So LeBron James has been a really good player for a long time. Well, let's say LeBron breaks into the NBA and he's so good. They're like, well, LeBron, you're too good. So you can only play 1/3 of the game, and then your teammates are going to have to deal with the opposing team without you for 2/3 of the game. That'd be nuts. You'd be like, no, LeBron became like a really good player. Maybe he was given some God-given abilities, but you wouldn't step in the way and do that. It'd be nuts. So why are you going to do that to Google or Meta? They got to their positions for the most part by being innovative, being creative, outthinking their competition, creating new markets. Google, the search business didn't exist before Google. Most other search engines, search optimization companies, they didn't see the monetization that Google did. And then Google dominated, and then they monetized. Well, good for them. They created a whole market, a whole industry. And now the government's like, well, we don't like that. We think you're too good. So on both fronts, I don't know if they're going to be broken up. If we follow kind of like the path that Microsoft ended up having to follow, they didn't get broken up. So I don't know why Google would be asked to be broken up. And same thing with Meta. I think the Google business is harder to break up, by the way. That one is everything kind of works together. You'd be really damaging a company. I'm a little more concerned about the Google breakup than the Meta breakup because Meta does have like Instagram could be kind of its own business and that stock would probably be worth a lot. Where Google, you're like, search works perfectly with YouTube and YouTube works perfectly with other aspects of it. You have I used to be a Microsoft Excel user, like hardcore user. Now I'm a hardcore Google Sheets user. And it took a little bit of a transitionary period, but now I think the Google Sheets product is brilliant. It's better than Excel. I think Microsoft's afraid of it now. And that's a great product. Well, if you look at all the integrations you can put into a Google Sheet, that's like totally innovative from Google. Let's reward people that are really, or companies that are really good and creating more value, not getting in the way. So I am a stockholder of both Google and Meta. So I might be kind of speaking or talking my book and defending companies that I invest in. But that's how I felt about Microsoft, even at a young age, because I was a youngster when that was happening 30 years ago. And the government, every time the government steps in and says, hey, publicly traded companies, you guys don't know what you're doing. I'm like, oh no, government, just you guys do take care of infrastructure, take care of the military. You guys do that well. Take care of law enforcement, that kind of stuff. You guys do that really well. Stay out of like innovative markets. You guys don't know what you're talking about. And that's how I feel about it with Google and Meta. But we'll see how things play out. It's kind of a long answer to your question, but I don't think anybody really knows what's going to happen there. Google and Meta hopefully are left intact and maybe have to comply to certain things the government says, hey, well, we want you to do this or that. Okay, that's cool, but just kind of let them be. So that's my answer to that question. Thanks for asking, and we'll see how it plays out. Meta's stock has been getting hammered. It started the year so well, right? It was up 25%, and then it just started to go downhill from there. So we began the year, it went up 25%, nice. And then from there to here, it's down 34%. Owie. Year to date's down 17%. So this is a combination of the market sold off and the whole scare that it's going to be broken up. That uncertainty if Meta's going to be, this big company. And the uncertainty, like when you think about Meta's building this Meta AI business. And Meta AI is going to be integrated in Instagram, Facebook, WhatsApp, Threads. And eventually Meta said they're going to create a short form video platform. And that's where I think if you broke up Meta, you're disrupting an innovation cycle by an American company in the AI space. And again, be careful because the US kind of halts a US company. And then all of a sudden, let's say DeepSeek or Alibaba, Chinese, AI technology comes in. It becomes a big, successful venture in the US. We'll look back and go, yeah, good job, US government. You interrupted a US company from innovating on Meta AI, and now, a different company is taken over and it's less desirable than what we started off with. So we'll see. I hope they leave them alone. With regards to Google, they've also been highly sold off. Year to date, this stock has not done well. It's down 21%. It's just been a consistent downward spiral or downward trend. And it really peaked here February 4th. Wow. Down 28%. Not good. The 1 year negative, year to date negative 21. 5 years still okay. But Google Alphabet, in my book, both Google and Meta are discounted. Their stock prices have really come down below intrinsic value. And man, if you want to own Google, it's a good time to own Google. P ratio of 19.4. And that's interesting that they have a P ratio of 19. Here on stock analysis, it's 18.6. That's not a bad PE ratio on a company that's as powerful as they are, growing their revenues, growing the number of, I guess, customers they have. The one negative point about them is they're spending too much in the data center, and the cash flow has been declining a little bit if you look at the quarterly. So that would be one bad mark that hopefully they correct. Free cash flow, it's actually upward. So they are spending more on the data center, but even with that additional spend, it looks like their cash flow continues to rise. So this is there's only one Google. There's only one Google Alphabet, and there's only one Meta. I want to own them. I own a lot of shares in both. So we'll see. We'll see if the FTC can just leave them alone. Yeah. Yeah, and Brandy, you bring up China, and the one thing, the Chinese stocks have been weathering this downturn a little better. Alibaba being, one of the stocks that the Chinese stocks are doing okay. This one's up 29% year to date. Looks good. And the PE is still 16.3. But you think about, are these tariffs making Alibaba stronger or weaker? It's making them stronger. Alibaba does not make their money by selling stuff in the US. They do sell a little bit. Most of their stuff is sold in China or other parts of Asia or other parts of the world, like Latin America, Middle East, Europe. And in those markets, they actually have a better position now than they did, let's say, a year ago, because I think the tariff war is kind of making China look a little better in the global stage. It's the U.S. that instigated it, and we're probably looking like the ones that are big, the troublemakers. Alibaba stands to benefit there because they're a Chinese entity. They can do more commerce with all parts of the world except for the U.S. They don't do a whole lot in the U.S. right now. Their cloud business is good. Their AI app is good. Their AI models are good. So Alibaba's looking good, as well as the other companies that are in China. So I think if we look at a list of Chinese stocks, you see a lot of green. And I showed you the heat map for U.S. stocks. Not a pretty picture, but we go to Chinese stocks and you see green. Alibaba's doing well. NetEase is in the green year to date. Prudential, this is, I guess, the part of Prudential that's in China. It's doing well. XPeng is just on a tear, 53%. And you see some green on the screen here on a year where the stocks in the U.S. have just been really hammered. So Chinese stocks are doing well. I also have a couple of stocks in Latin America, like Mercado Libre and New Holdings, and they're doing, Mercado Libre specifically is doing really well. So it's not a bad time for me to look for international stocks. I also own BHP in Australia, a couple of others, and it's really opened up that door a little more open to me buying outside the U.S., just because right now the U.S. market's got its problems. Mike, good to see you. Good luck to you. And you've been adding to Meta. Awesome. Good to see you. Thanks for checking in. Dot Capital. Good to see you. Thanks for joining. All right. So Brandon, they have the product and they have the cards. Yeah, I agree. Good stuff. So I wanted to talk about a couple other stocks, if I may. Let's start off with Tesla. So, okay, this is where I left off is earnings. So earnings today was kind of a small company day. There was, some companies announced, nothing really big. I think MedPace was a little bit interesting to me. I don't even know what these guys do. So let's take a peek. But tomorrow, Tesla announces, and man, I wanted to look at Tesla stock. Tesla's just gotten destroyed for the last 3 months or so. SAP's a software company, pretty good cap. General Electric, Verizon, just big name after big name. Intuitive Surgical, RTX, Danaher, Chubb, Lockheed Martin, Elevance, Northrop, Moody's, 3M. It's just a lot of volume of a lot of earnings. Now, this could cause a pivot and we can go up higher if we hear a lot of good news tomorrow. If, okay. I'm not saying we're going to. I'm just saying tomorrow, if you get a lot of good news, this can make the market go. If we hear bad news, I don't know that we're going to have much of a sell-off. I think everybody's expecting it's not going to be pretty with Tesla. They're going to announce that, hey, we're not selling as many cars. No big deal. Let me tell you about Robotaxi. And then the stock will be, I don't know, might go up, might go down. I don't know. We'll see if the investor's still willing to buy into stories versus fundamentals on Tesla. SAP will tell us something about their market. They're a big company, software company. That'll be interesting. General Electric will tell us about their business. I believe this is the turbine business that, puts turbines on airplanes. And then they also, the turbines go in other use cases. Verizon. So these here, will be very interesting to kind of set the table. And it just the volume keeps increasing on Thursday. Am I missing a day? Yeah, I think so. On Wednesday, Philip Morris, IBM, volume's really high. ServiceNow, they've been a big beneficiary of the AI story. I think they're overpriced big time. And we'll see. We'll see if they can keep their valuation or if they're going to get hammered. But there's a lot out there. Thursday, Google Alphabet. That's a big one. That one will move the market. Procter & Gamble. That one's a nice staple stock, but it hasn't been doing all that great. I think Procter & Gamble, to my surprise, for the last couple of years, flat, which is interesting, especially now when staples are doing so well. T-Mobile, Merck, Union Pacific, just high volume of earnings. Then Friday shouldn't be too bad. AbbVie is pretty big. It'll move the markets, and then some smaller companies. So, the volume of earnings this week is huge, and I think that's what's going to move the market. Tomorrow, it's after the close is when the big Tesla earnings are going to be announced. But in the morning, it'll be interesting to see what General Electric, Verizon have to say, RTX, Elevance, and healthcare. United Healthcare got smoked after their earnings. Their stock went down like 23% on earnings announcement. Elevance is exactly in their industry, but they're smaller. I think they have better fundamentals, and they've done better. We'll see how they make it through their earnings. Hopefully, they have far better earnings than United Healthcare. So big earnings this week. As we approach earnings, just looking at Tesla, it's just really setting up. I don't know if you can have any lower expectation on Tesla. It's like things are just broken. It's down 43% year to date. I mean, they can announce that, the volume of cars being sold is super low and, That's not going to move. They're going to announce robotaxi. I think if they were to announce that, hey, robotaxi just isn't going to happen as soon as we thought, it's going to be like 3 years before we can really get that business going, that could move the stock lower. If they announce that, hey, we're going to have like the first city, I think they're trying to launch in Austin. That's expected. That should not move the stock up, but who knows? It's Tesla. Elon Musk has been kind of a super popular CEO, and he tends to, speak in stories, and those stories really move the stock. It may do it again. I don't know. I've always been surprised as to how hard the stock rallies on stories. Like, wow, if it was that easy, why doesn't every CEO do it? Well, because investors are smart and they're like, whatever, a story without fundamentals is just a fantasy. Show me fundamentals. Show me revenue growth, profit, free cash flow. Show me a good balance sheet. Show me those fundamentals, and then I'll believe your story. But with Tesla, he kind of gets away with it, and whatever. I'm not a Tesla stockholder for that reason. So Tesla is going to be super interesting tomorrow, and we'll see where that goes. All right. So the next one, got a request. Give me a second. So HCA, you want to take a look at HCA. HCA Healthcare. HCA Healthcare, through its subsidiaries, owns and operates hospitals and related healthcare entities in the United States. It operates general and acute care hospitals that offers medical and surgical services, including inpatient care, intensive care, cardiac care, diagnostic, emergency services. Okay, so do they own the properties or do they operate the hospitals? So HCA Healthcare. So it looks like they actually operate the hospitals. So it's not like a real estate investment trust. These guys are in the healthcare services industry, providing all these services. Okay. Wanted to know that because if it's a real estate investment trust, it's kind of a different animal altogether. And it's not like a healthcare company, like a pharmaceutical or med device company. They are providing the services. $78 billion market cap, $70 billion revenue. So you're paying a little bit over 1 times revenue for the company. Low PE of 14. Okay. They pay a dividend 0.91. So they have consistent growth. So that looks good. What's your stock done? So for the year, up 4%. That's a good chart. It's a really good chart. So they went from $100 a share up to $317 a share. Very good. And over the last 5 years, they've shown growth. So really that run is on this positive growth rate right here. And they are sticking to that growth. Single digit, they're getting bigger. So that number gets a little harder to keep your revenue, your percentage growth rate, but it looks good. So it's a profitable entity. Looks good. So free cash flow, it hasn't been growing a whole lot, right? They had a really nice cash flow year in 2020. It was probably because they were receiving a lot of COVID related services. Then 21, they were probably still dealing with COVID. It dipped down, then it's been growing again. So a stock like this, I would naturally multiply it times 15. And if I multiply this number times 15, I'm going to arrive at around $80 billion in market cap value, because that would be 28 it'd be 84 billion in market cap value minus debt. So I'll take a look at where we end up there. Now this is a services, they render services, so the gross margins aren't great. So that's expected. And let me see how much debt they have. Debt could be a problem. I don't want a lot of debt. So the debt is really high. 45 billion in debt. Net debt 43 billion. Man, that kind of kills my buzz. Let's look at the debt to EBITDA. So right there, 3. They're right there at the maximum. But this really affects my valuation because I shared that it was 84 minus that 43. I'm down to 41 billion. So I actually think this stock is priced too expensive. You have that debt, right? So the market cap, the way I value stock, and I can do this one fairly quickly. So why don't we do that? I'm going to open up another browser and I'll quickly do this one. Okay, so I'm going to use this as kind of just a template, but then I'll change all the numbers that need to be changed. All right, so I thought the debt was a little a little high. So I'm going to move this to 8.5%. And we'll start updating some data here. So it looked like their free cash flow was good at $5 billion, $639 million. It has been growing. So since they're growing single digit, I'm going to improve it by 5%. Might be a little conservative, but it's healthcare. So let's just leave it at that. And that's 2024. Okay, that's fine. Gives me an intrinsic value of 126 billion. Cash on the balance sheet is $2 billion, 20 million. And we got debt of 45 billion, 240 million. So the equity value is 82. Market cap is 78. 6% discount on the stock. So that's not wildly exciting, right? It's kind of like just there. It's fairly priced. Now, looking at where their earnings per share is going to be. So earnings per share is going to be $25.17. It's supposed to grow low teens. So I'll grow it. Yeah, 8% is fine. Maybe 9%. And if we look at earnings per share, it provides a really nice, price target based on earnings per share. Overall, if I blend the two, I get to like an 18% discount. That's not really exciting. It's okay. The stock has performed really well. So the stock is kind of been priced, with the expectation they were going to continue to grow. They have a pretty good, price on them. I'm trying to say that they've been priced up for a while, and there's very little discount left. Now it's always your decision, but the type of investor I am, and a lot of like investors, Howard Marks, Warren Buffett. It's their intent to always get a good price on a stock. This is a lesser known name, HCA Healthcare. So would I get into a stock like this? Well, you'd have to give me like a 40% discount, something that's really meaningful that, hey, I can double my money over the next 5 years. I don't want to just kind of hold my investment. To give you an example, let's compare this to Johnson & Johnson, because J&J is a high quality company. And for a long time, the stock had been going up. Well, heck, over the last 5 years, Johnson & Johnson just basically delivered a 1.39% return over 5 years. That is failure. That's bad. I don't want an investment like that. I want an investment that's going to do better. And within healthcare, I'd rather go into companies like Catalyst. Catalyst is doing great. It's doing great for the 1 year. And when I look at their valuation, Catalyst, and I'm going to keep this guy, so I'm going to put it on the watch list. In healthcare, there is good choices. And when I look at Catalyst, it's still discounted because it's growing so well. It's growing really well. It's a smaller cap, I should say. It's got a $2.6 billion market cap. I raised the discount rate, and another way of saying discount rate is that's the rate of return that I want. And even using a 10%, which is higher than what we just used for HCA, it's still driving a 52% discount, 28% based on earnings per share, and 46 blended. I'd rather buy Catalyst than HCA because I stand to make more money. This has been a proven winner. Or ADM Biologics has a nice discount on cash. There's so many good deals within healthcare. Those choices, I'd rather go to those choices. HCA is not exciting enough for me. And because the acquisition price is not good enough, it's not compelling. It's a healthcare company. Are they going to double are they going to start growing at 30%? No, they're a single digit grower. So it's not going to be overly exciting. It's not like they're going to announce and say, oh, we started to grow at 20%. So I think that there's low likelihood that this one is going to amaze stockholders and really start getting on a big rally. So I'm going to be careful not to buy too many of these. I'd rather go to ones that I think can really cause a big rally, and they give me a good, risk reward situation. This one is not good enough. This is not enough of a reward. Who knows? Maybe these hospitals, right? There's so much liability involved. What if some bad thing happens? The next thing you know, they're getting sued through the nose, or, some of these hospitals underperform and they become a liability. All those things are in play, and I'd be careful with it. So those are my comments there. I'm going to go ahead and watch that stock since we did an analysis on it. I'll just insert a line here and put HCA, and I'll come back later and fill in the rest of the data. So thanks for asking about that. Brandon, let's see here. Where was I? Yeah, thanks for asking about that one, Brandon. And this will be like when I update the valuation library, it'll be in there. If you need anything in advance, just shoot me a message and I can copy and paste this to you. All right. JZAB. So Michael Anthony, all over Pfizer. Yeah, thank you, Brandon. Appreciate it. All right, cool. So we got through HCA Healthcare. All right, guys. So I'm going to go ahead and close it out. And looks like the market, probably we can't see the future, so I won't spend time on that. Want to invite you to become a member of the community. Easy to become a member. Let me take you to where you just click on this join button. and you can get signed up. And then if you're on the stream and you want me to review a stock like I just did for Brandon, that's one of the perks. If you want to get access to this valuation model, that's one of the perks. And then I basically update this library. It's many different stocks, and I provide access to it to the members, and you would be able to view it. It's just for, reference points. I'm not recommending you buy, hold, or sell any stock, but I'm showing like what I came up with. You can do your own analysis and so forth. So that's included as membership. And then we have member calls, which you can attend. Just a lot of perks. So hopefully I could see some of the names that I've been seeing, for about a year become members. And then we can talk on the phone on the member calls. So it'd be great to have you. So please consider it, and it'd be great to have you. All right, guys. So that is it for now. Everybody have a good night, and fingers crossed that these earnings are going to come in positive, and they maybe kick off a rally to pick up these share prices, because man, today was pretty red. I could use a little green for the rest of the week. All right, everybody, have a good night. Take care.